Every time you sign a mortgage, you're making a bet, not just on yourself, not just on the housing market. You're making a bet on the price of a barrel of crude oil pulled out of the desert 6,000 miles away. And the interest rate on that mortgage? It was partially set by a decision a Saudi finance minister made about where to park a few $100 billion. That link between a wellhead in the Persian Gulf and your monthly payment isn't a coincidence. It's architecture. A financial loop designed 50 years ago that still runs underneath the entire global economy like background code most people never see. To understand how oil prices touch your mortgage rate, you have to go back to 1971. That's when President Nixon pulled the plug on the Bretton Woods system, ended the convertibility of dollars into gold. Before that, the dollar had a fixed anchor. Every dollar in circulation was theoretically backed by gold sitting in a vault. Once that link broke, the dollar became what every other currency was, a promise backed by trust, not metal. And trust, in global finance, needs a reason to exist. 2 years later, the reason showed up. In 1973, OPEC imposed an oil embargo. Prices quadrupled almost overnight. The world got a brutal reminder of a simple fact. Modern economies run on oil. Every factory, every shipping lane, every commute, all of it converts petroleum into productivity. And suddenly, the countries sitting on top of that resource had an enormous pile of US dollars flowing in, far more than their domestic economies could absorb. Saudi Arabia alone was collecting billions it had no way to spend locally. Small populations, undeveloped infrastructure, nowhere near enough internal demand to soak up that kind of capital. So here's the problem. You've got oil-exporting nations drowning in dollars. You've got the United States with a newly untethered currency that needs global demand to maintain its value. And you've got the rest of the world needing dollars to buy the one commodity nobody can live without. That's not just a problem, that's a design opportunity. In 1974, US Treasury Secretary William Simon and Secretary of State Henry Kissinger brokered what became the foundational arrangement of the petrodollar system. The deal with Saudi Arabia was straightforward in concept. The US would provide military protection and arms sales. In return, Saudi Arabia would price its oil in dollars and, this is the part that matters for your mortgage, reinvest its surplus oil revenues into US Treasury bonds. Within a year, the rest of OPEC followed Saudi Arabia's lead. Every barrel of oil sold anywhere on the planet now required US dollars to complete the transaction. That created the loop, and the loop is everything. Here's how it works, step by step. A country, let's say Japan, needs oil. To buy that oil, Japan first needs to acquire US dollars on the foreign exchange market. That creates demand for dollars before a single barrel changes hands. Japan pays Saudi Arabia in dollars. Saudi Arabia now holds those dollars, but its domestic economy can't productively deploy hundreds of billions. So Saudi Arabia takes those dollars and buys US Treasury bonds, essentially lending money back to the American government. Those Treasury purchases push bond prices up, which pushes yields down. And here's where your mortgage enters the picture. Your 30-year fixed mortgage rate is benchmarked against the yield on the 10-year US Treasury note. When Treasury yields drop, mortgage rates tend to follow, typically sitting about 1.5 to 2.5 percentage points above the 10-year yield. So when oil exporters pour hundreds of billions into treasuries, they're creating downward pressure on the very benchmark that determines what you pay to borrow money for a house. The dollars flow out of America to buy oil, then flow right back in as investments. And in the process, they subsidize the cost of American borrowing. Between 1974 and 1981 alone, OPEC nations accumulated roughly $450 billion in current account surpluses. 90% of that came from the Gulf states. By 2008, OPEC revenues were hitting $1 trillion a year. And by 2014, sovereign wealth funds worldwide, many of them built on petrodollars, had amassed over $7 trillion. Much of that money, year after year, kept cycling back into US financial assets. Now think about what this means for the average homebuyer. When oil prices spike, oil exporters collect more dollars. More dollars means more capital available to reinvest in treasuries. More treasury demand means lower yields. Lower yields mean cheaper mortgages. That's the counterintuitive version of the loop. But there's a second pathway that works in the opposite direction, and this is the one most people instinctively understand. High oil prices drive up the cost of producing and transporting goods, which drives up inflation. When inflation rises, bond investors demand higher yields to compensate for the erosion of their returns. Higher yields mean higher mortgage rates. So oil prices actually pull your mortgage rate in two directions simultaneously. The petrodollar recycling effect pushes rates down by flooding the Treasury market with foreign capital. The inflation effect pushes rates up by making fixed income investments less attractive. These two forces can operate at the same time, on the same interest rate, creating a tug-of-war that most economic commentary completely ignores because it's easier to tell a simple story. Which force wins in any given moment depends on the speed and magnitude of the oil price move, what the Federal Reserve does in response, and how much of that oil revenue actually makes it back into treasuries versus getting routed into real estate, equities, or sovereign wealth fund diversification plays. This is why the system is so hard to see. It's not a single clean signal. It's two opposing forces operating on the same variable at the same time, mediated by institutions and decisions happening in Riyadh, Washington, and bond trading floors in London. You can't reduce it to oil goes up, mortgage goes up. The real answer is oil goes up, and two different mechanisms fight over what happens to your borrowing cost. The outcome depends on which side of the loop is stronger in that particular moment. And here's the part that makes this truly elegant as a system design. The United States gets to run persistent trade deficits without the consequences that would normally destroy a currency. Normally, if a country imports far more than it exports, its currency weakens because dollars are flowing out faster than they're flowing back in. But petrodollar recycling reverses that outflow. The dollars leave to buy oil, then return as investment capital. The constraint that normally limits deficit spending, the risk of currency collapse, never fully binds. The US gets to borrow cheaply, run deficits, and maintain dollar dominance all at once. Think of it like a game where one player designed the resource system. Everyone else has to farm the same currency to access the most important item in the game. The designer doesn't have to farm at all. They print the currency. That's not a cheat code. It's architecture. For the rest of the world, the loop imposes a different kind of discipline. Every nation that needs oil has to hold dollar reserves. Those reserves represent real economic resources, goods and services exported in exchange for dollars that then sit in a central bank vault or get parked in treasury bonds. That's productive capacity converted into American IOUs. It's not exploitation in the traditional sense. It's a system where participation is enforced by necessity, because the alternative, trying to buy oil without dollars, has historically been far more expensive and far less liquid. Now, the obvious question is whether this loop is weakening. There are real signals worth watching. China has launched yuan-denominated oil futures contracts. Russia has demanded payment in rubles for some energy exports. Several OPEC members have made noises about diversifying away from dollar-denominated reserves. Gulf sovereign wealth funds are spreading their investments across a wider range of global assets rather than concentrating in treasuries. Foreign participation in US Treasury auctions has shown some signs of decline. But here's what makes the petrodollar loop resilient, and why headlines about its death tend to be premature. Breaking it is expensive for everyone, including the countries that complain about it the loudest. The dollar-based oil market is the deepest, most liquid commodity market on Earth. The US Treasury market is the largest, safest bond market available. Switching to alternatives means accepting less liquidity, more volatility, and higher transaction costs. No single alternative currency, not the yuan, not the euro, not a hypothetical BRICS instrument, currently offers the combination of depth, trust, and convertibility that the dollar does. The system persists, not because every participant loves it, but because the cost of leaving exceeds the cost of staying. For anyone trying to understand their own financial position within this system, the takeaway isn't prediction, it's awareness. Your mortgage rate is not determined in a vacuum. It sits at the end of a chain that runs through oil fields, sovereign wealth funds, treasury auctions, and bond markets. When you see oil prices move, you're watching one input into a mechanism that ultimately touches the single largest financial decision most people will ever make. Understanding that chain doesn't give you the power to control it, but it does let you recognize that the price tag on your house is connected to systems most people never think to examine. If this kind of systems-level breakdown changes how you see the financial architecture around you, consider subscribing to 8-Bit Economics. Every week, we strip complex financial mechanisms down to their core code. No hype, no predictions, just the underlying systems that actually move your money. Hit subscribe. Like the video if it shifted your thinking, and drop a comment with your take on where the petrodollar loop goes from here. By the time everyone sees it coming, the smart play is already over. Here's the thing that should stay with you. That 1974 arrangement wasn't just a diplomatic handshake. It was the installation of a financial operating system that still processes trillions of dollars a year. Your mortgage rate, the strength of the dollar in your wallet, the price of imported goods on the shelf, all of it runs, at least in part, on code written half a century ago by men trying to solve a problem that no longer exists in its original form. The gold standard is gone. The oil embargo is history, but the loop they built to manage the fallout, it's still running. And every time you make a mortgage payment, you're interacting with it, whether you know it or not.